Hey everyone, and welcome to the channel. Today we will take a look at Novo Nordisk, the pharmaceutical giant that's been making headlines with its blockbuster weight loss and diabetes drugs. We'll break down the company, its recent stock price drop, and what the future might hold. Novo Nordisk, traded on the New York Stock Exchange under the ticker NVO, earns its money primarily from the development and sale of pharmaceutical products, with a heavy emphasis on diabetes and obesity treatments. Their revenue model is very concentrated in a few blockbuster drugs. Let's break down their revenue segments. Diabetes care. This is their biggest growth driver, accounting for about 70% of revenue. This includes their traditional insulin products as well as their new GLP-1 receptor agonists like Ozempic and Rybelsus. Ozempic, in particular, is a multi-billion-dollar product. Obesity care. This is their fastest-growing segment, making up about 25% of revenue and expected to rival or even surpass diabetes in the future. This is powered by Wegovy, which has seen overwhelming global demand and is often in short supply. Rare disease treatments. This is a smaller but still profitable segment at around 5% of revenue. This includes treatments for rare blood disorders like hemophilia and growth hormone therapies. In 2024, Ozempic and Wegovy combined accounted for more than half of Novo Nordisk's total sales. Recently, the company's stock has faced significant pressure, with a nearly 70% decline from a high of $143 in May 2024 to just $45 as of August 6, 2025. In my opinion, there are several key factors that could have contributed to this sharp drop. 1. Lowered guidance and leadership change. Novo Nordisk downgraded its 2025 sales growth and operating profit guidance, which caused the stock to drop more than 20% in a single day. This reflects weaker-than-expected performance, especially for Ozempic and Wegovy in the U.S. market, which has been impacted by competition and the use of compounded drugs. 2. Competition from Eli Lilly. A major competitive threat comes from Eli Lilly's tirzepatide, sold as Mounjaro and Zepbound. To stay ahead, Novo Nordisk is actively pursuing R&D to develop next-generation drugs. 3. U.S. pricing pressure. Concerns over drug pricing have been amplified by political pressure in the U.S. The company is responding by offering rebates, broadening access, and scaling up supply to offset potential price reductions with higher sales volume. Let's break down the revenue. Novo Nordisk's business is powered by two main segments: diabetes care, which makes up a dominant 71% of sales, and the rapidly growing obesity care division, which accounts for 22%. The remaining 6% comes from their rare disease business. Globally, their revenue is heavily concentrated in one place: North America, which brings in a massive 66% of total sales. The rest of their business, or international operations, makes up the remaining 34%, divided between EMEA, 16%, Region China, 8%, and the rest of world, 10%. In short, Novo Nordisk's growth is driven by its diabetes and obesity drugs, with North America leading the way. A key long-term concern for any pharmaceutical company is patent expiry. For Novo Nordisk, their biggest revenue drivers like Ozempic, Wegovy, and Rybelsus are protected in the US and Europe until 2031 and beyond. This is good news, as these regions account for about 82% of their revenue. The patent in China expires earlier, in 2026, but the impact on total sales will be limited since China only accounts for about 8% of their revenue. The big question is whether their pipeline of next-gen drugs will be ready before the patent cliff in 2031. This makes their pipeline a crucial area to watch. Historically, Novo Nordisk has shown consistent growth, stable margins, and high returns on capital. While past performance is not a guarantee of future results, it remains a strong indicator of potential. The company's free cash flow margin has recently compressed, largely due to massive capital expenditures to build out manufacturing capacity. When we look at valuation, A simple discounted cash flow model based on a conservative 10% growth rate suggests a fair value of about $65 per share. With the current share price at about $57, this provides a slight margin of safety and represents a potential buying opportunity of a great business at a fair price. Moving on to the price multiple valuation. We're going to use a different metric here, the enterprise value to sales or EV to sales multiple. This ratio is great for comparing companies with different levels of debt. It essentially tells you what the market values the company at for every dollar of sales it generates. Looking at the snapshot, Novo Nordisk's current EV to sales is around 5.4x. Our analysis shows that the estimated low point for 2025 is around 4.4x, a level not seen since 2011 and 2016. The historic low for this multiple was around 2.9x, way back in 2009. Our target is an EV to sales multiple of 10x. If the market re-rates the stock to this multiple, it could imply a target price of around $107 per share. In simple terms, our investment takeaway is that Novo Nordisk currently offers a low-risk entry point given its historical valuation multiples. So what's the takeaway? The current situation presents a thesis of high uncertainty, low risk. The current valuation offers a chance to own a great business at a fair price. 2 years ago, I would never have expected that I would be able to own Novo Nordisk stock in the 50s. There is potential for the stock to double to around $107 per share if it returns to a historical EV/sales multiple of 10. The key catalysts to watch for are manufacturing scale-up, pipeline momentum, obesity market expansion, capital returns. That's our breakdown of Novo Nordisk. What do you think about the company's future? Let me know in the comments below. Don't forget to like and subscribe for more content like this. Thanks for watching, and I'll see you in the next video. Bye.